Good evening, dear students. So we are gathered for the second last session, that is analysis of financial statements. So as part of this discussion, we'll be running through a couple of questions that we deal for the analysis purposes. We will also run with what exactly do you mean by financial statements, why that is important, what should be the characteristics of the statements, and we will also see a brief run of the schedule 3 that is applicable to us. And after the schedule 3 we'll see a couple of questions at least for today and close it, and then the next class that is scheduled will do the remaining. Okay, hi, good evening Shruti, good evening Satish, good evening Mohammed, good evening guys. Okay, so, as of now, when we talk about corporate entities, the format is in line with Schedule 3 to the Companies Act 2013. All of us are very well aware of it. There are several additional disclosure requirements with respect to the balance sheet and statement of profit and loss. That also everybody is aware of. However, certain industries have their own balance sheets which are prescribed, like you have the banking and the insurance sectors. So that fact has also been recognized in the Companies Act 2013 in the proviso to section 129(1), which states that for these companies, Schedule 3 format is not going to be applicable. Achha, coming to the Schedule 3 format, it is a vertical format of balance sheet, and there is no alternative of using the horizontal format, something which all of us know on a day-to-day basis. Okay, good evening, Mansha. Good evening, Viraj. Okay. What is important to note is Schedule 3 sets out the minimum requirements for disclosure. अच्छा, minimum का मतलब maximum नहीं होता है. So minimum requirement means this is what you have to disclose. There is no avoiding this disclosure. If you want to disclose something over and above this, you are perfectly at your liberty to do so. You are perfectly at liberty to do so. Please go ahead and do that. Okay. It sets out the minimum requirements for disclosure on the face of the balance sheet and the statement of profit and loss. It also allows line items, sub-line items, subtotals to be presented as an addition or substitution on the face of the financial statements when such presentation is relevant to an understanding of the company's financial position or performance, or to cater to industry sector specific disclosure requirements, or when required for compliance with the amendments to the Companies Act or the standards. Means बहुत बड़ा sentence है, but the core of this is the Schedule 3 format is a little bit flexible. You can add line items, you can substitute line items, you can put in subtotals, you can put in totals the way you want if you believe it is going to give the reader of financial statements a better understanding. If that is what your industry peers are also following, so you are at liberty to do that. So there is a flexibility that is involved in Schedule 3. Apart from, okay, so Schedule 3 now requires all disclosures to be made as a part of the notes. Okay. Apart from granting an overriding status to the standards, cognizance has also been given to the requirements of the standards in the format of the balance sheet, and accordingly, elements such as deferred tax assets, intangible assets have also been included in the balance sheet. It has been clearly stated that the disclosure requirements specified in Part 1, 2, or 3 of Schedule 3 are in addition to and not in substitution of the disclosure requirements specified in the respective notified standards. So in our standards, we have disclosures. So the disclosure requirements in Schedule 3 are in addition to what is specified in the standards. It is not in substitution of that. Okay. And one of the pertinent aspects with regard to Schedule 3 is that it does not prescribe the accounting treatment to be adopted by the entity. It only prescribes the format and the content. Consequently, the fact that the particular item has been included in the format does not imply that the particular item can be recognized in the balance sheet. Obviously, so it is a format which is given. You have to apply that format based on what is applicable to you, what is not applicable to you. It is only giving presentation and not the treatment of these items. Okay, so the treatment is governed under the Ind AS, which you have already studied, but the presentation of those items is what is specified in Schedule 3. So we'll quickly run through Schedule 3. You are aware of the formats. Have you done Schedule 3 when you prepared your consolidation questions, when you have done business combination and consolidation? Yeah, have you done that? Yeah. So if you have done that, I presume you would be a little bit familiar with what is there. Okay. You would be a little more familiar with the Schedule 3. Okay. So a couple of key points that are there. A couple of key points. So every company to which Ind AS is applicable, this is Division 2, which applies to Ind AS applicable entities. So every company shall prepare its financial statement. Shall means mandatory. Okay, shall means it is mandatory. Its financial statements in accordance with this schedule or with such modification as may be required in the certain circumstances. Okay, so that is there. Notes, what all is there, you can just go through, nothing major. Okay. The key fact right now is that rounding off is mandatory. Rounding off is mandatory. If your total income is less than 100 crore rupees, then the rounding off will be to the nearest hundreds, thousands, lakhs or millions or decimals thereof. So बिना rounding off के balance sheet अब नहीं बन सकते. This is there in the division 1 also, that is the regular financial statements that we have for non-Ind AS entities. Rounding off होना ही है. We cannot present the full numbers right now. And if your turnover is 100 crore rupees or more, you will round off to the nearest lakhs, millions or crores or decimals thereof. And once you are using any one rounding off, please ensure that you maintain uniformity in the financial statements. Somewhere you use in hundreds, somewhere you use in lakhs, somewhere you use in thousands. It will be very difficult for the reader of financial statements. So कौन सा भी एक use करो and follow it entirely in the financial statements. Okay. It shall contain the comparatives, that is corresponding amounts for the immediately preceding reporting period, except in the case of first financial statements laid after incorporation, obviously. Okay. Disclose all material items. That is, when you say material items which individually or collectively could influence the economic decisions that the users make on the basis of the financial statements. Materiality depends on the size or nature of the item or a combination of both to be judged in the particular circumstances. For example, related party transactions. Regardless of the size, they are always material. So you have to disclose related party transactions separately. वहां पे the size does not matter. Okay. It could be a very small amount, but because it is a related party transaction, you will have to disclose it separately. So the nature is what gains precedence over the amount. Okay. And in some other cases, you may be having, like, for example, when you are disclosing other expenses in your profit and loss account, you can club various expenses and present it as other operating expenses because of the fact that individually these items are not really material to the financial statements. Okay. All right. When any act or regulation requires specific disclosures in the standalone financial statements, they shall be made in addition to those required under this schedule. So very straightforward, nothing difficult or nothing new that you have been doing. Okay, so now this schedule sets out minimum requirements for disclosures on the face of the financial statements. What do you mean by financial statements? The balance sheet, statement of changes in equity, statement of profit and loss, and the notes. Cash flow statement shall be prepared where applicable in accordance with the requirement of relevant Indian accounting standard, that is Ind AS 7. Line items, you can add, deduct whatever is there. We have already seen this. Okay. So this is your vertical format of Division 2 Schedule 3. Okay. So we start up with assets. This is exactly how it is there in foreign companies also. That is companies outside India, how they present. So we are almost aligning ourselves to those companies. So you start off with assets. In assets, you first present non-current assets. Property, plant, equipment, capital, work in progress, investment property show goodwill as a separate line item. Other intangible assets under development, biological assets, other than bearer plants. So where do bearer plants go? Bearer plants will go under property, plant and equipment. It is covered under Ind AS 16 also. So that is why other than bearer plants is written here. When you talk about financial assets, you will cover your investments, trade receivables and loans, deferred tax assets, other non-current assets. Current assets, inventories, financial assets may you have investments, trade receivables, cash and cash equivalents, bank balances, loans and others to be specified. Current tax assets, net and other current assets. So current tax assets could be your withholding taxes which are withheld on your incomes like your TDS for example. Okay, so they would basically come and sit under current tax assets. Later on, you move on to the equity. So equity will be classified into equity share capital and other equity. Then liabilities, you have non-current liabilities. In that, financial liabilities, basically your borrowings, lease liabilities, trade payables. What is important in trade payables is you disclose the dues of micro and small enterprises and other than micro and small enterprises separately. Okay, so you give the allocation of this and other financial items other than those specified in item B to be specified. Provisions, DTL, other non-current liabilities. Current liabilities, again, you have borrowings, lease liabilities, trade payables with the split between micro and small and other trade payables, other financial liabilities, other current liabilities, provisions, current tax liabilities, and total equity and liabilities. So in India, we are still using the term balance sheet for this, whereas in the foreign countries, we are using the term statement of financial position. So that is what they typically use, or statement of assets and liabilities. But here we are sticking to our adage of balance sheet. So that is the one change which is there. Coming to the next one, statement of changes in equity, you will present it for each item of reserves and surplus that was there erstwhile under the earlier regime. So each item you will present what is the opening balance, what is the changes due to prior period errors, restated balance. This is in line with the standard on prior period items, errors, etc. Changes in equity share capital during the current year and balance at the end of the current reporting period. So you will do it for the current period as well as the previous reporting period. And then other equity, you will present it for each item of reserves and surplus. It could be share application money, reserves and surplus, debt instruments, equity instruments, etc., etc. All these items you will present it in a similar manner. Okay, so this is something which you will present. You don't have to remember all these formats right now because what is applicable to you in the questions, only that is something which you will have to look into. Okay, so current period, previous period, you will have to do this. Okay, all right. So what do you exactly mean by current? Current asset means an entity shall classify an asset as current if it expects to realize the asset, a trade receivable, for example, or sell or consume inventory, for example, in its normal operating cycle. It holds the asset primarily for the purpose of trading, expects to realize within 12 months after the reporting period, or the asset is cash or cash equivalent unless restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. So all these, if you meet any of these criteria, it becomes a current asset, and all other assets will be classified as non-current. Okay. The operating cycle of an entity, the time between acquisition of assets for processing and their realization in cash or cash equivalents. And where you are unable to identify, it will be assumed to be 12 months. Okay. Liability as a current liability when you expect to settle in the normal operating cycle, or if it is held for the purpose of trading, due to be settled within 12 months, does not have an unconditional right to defer settlement for at least 12 months after the reporting date. So all these together, you meet any one condition, it becomes a current liability. An entity shall classify all other liabilities as non-current. Okay, so this is something which you already are aware of. Okay, and then you are having various disclosures for property, plant, equipment. What are the splits that you are going to give? As leases, you show separately. You show the opening gross block, accumulated depreciation, closing net block. All these things you will show separately. Okay, so all this you can just go through whatever are the broad headings under which you will present your property, plant, equipment, as well as intangible assets. How will you present your investments? And then under each classification, you give categorizations like subsidiaries, associates, joint ventures, or structured entities, etc. So this you can just read it out of curiosity. Okay, coming to the next one, the most important changes. I'll just highlight whatever is important, what has been amended recently. So your trade receivables, you are going to categorize it as trade receivables considered good, which are secured, considered good which are unsecured, having a significant increase in credit risk, and trade receivables which are credit impaired. These two are something in line with Ind AS 109, which you have said, where you have an expected credit loss that is being provided for in line with Ind AS 109. Okay, so that is something which you are having. Allowance for bad and doubtful debt shall be disclosed under the relevant heads separately. So for each of them, you will present your bad and doubtful debt provisions separately. Debts due by directors or other officers of the company or any of them severally or jointly with any other person, or by firms or private companies where a director is a partner or a director or a member, should be separately stated. So basically dues from directors, his company, his firms, where he's a director or a partner or a member, etc., you just disclose it separately. The additional requirement that has come is you are going to have to present an aging of the trade receivables of the current as well as the previous period. This was introduced, I believe this was introduced last year. Yeah, so outstanding for the following periods from the due date of payment. This is not the invoice date. This is outstanding from the due date of payment. So basically, you're having invoice date, then you are having the due date based on the credit terms, and after that, how much it becomes overdue. So basically, these are overdue agings. Okay, overdue aging that is required to be given, not the current ones. Okay, so less than 6 months, you present. 6 months to 1 year, you present. 1 to 2, 2 to 3, more than 3, and total. So this is something which you are going to present. And the same categories, okay, undisputed, which have significant increase, credit impaired, disputed trade receivables, where there is a credit increase, and credit impaired. So this is something that you will be presenting. Unbilled dues shall be disclosed separately. Unbilled dues shall be disclosed separately. Basically, this talks about something like your contract assets, which we have studied in Ind AS 115, where you have performed the obligation, but probably you have not raised an invoice, but you have to recognize the revenue in line with the standard Ind AS 115. So there you will have to have a contract asset that gets created. So it becomes an unbilled due. So you will have to disclose it separately. Coming to loans, this is the requirement. Okay. I'm just hurrying it up because I want to cover the other more important parts of today's discussion. Okay. So anyways, this is other financial assets, current assets, all the categorizations that you are going to do. Again, in your current assets, you will disclose trade receivables aging in the same manner. And cash and cash equivalents, other financial assets, other current assets, all of them you will disclose separately. When we talk about equity share capital, you will disclose the authorized capital, number of shares issued, subscribed, and fully paid, as well as subscribed but not fully paid shall be presented separately. Par value per share, reconciliation of shares outstanding at the beginning and at the end of the period, rights, preferences, and restrictions, including restrictions on the distribution of dividends and the repayment of capital, shares in respect of each class in the company held by its holding company or its ultimate holding company, including shares held by subsidiaries or associates of the holding company or the ultimate holding company in aggregate. Shares held by each shareholder holding more than 5%, we have been doing this. Shares reserved for issue under options and contracts or commitments for the sale of shares or disinvestment. For the period of 5 years immediately preceding the date at which the balance sheet is prepared, you will give the aggregate number and class of shares allotted as fully paid pursuant to contract without payment being received in cash. Okay, so fully paid up non-cash consideration you will disclose, and bonus shares you will disclose separately, and shares bought back you will disclose separately for any of these corporate events which have happened in a period immediately preceding 5 years from the balance sheet date. Okay. Terms of any securities convertible into equity shares with the earliest date of conversion, calls unpaid forfeited shares, and disclose the promoter share as under with the percentage change that is there during the year. Okay. Other equity, you give the categorization of the reserves, and if they are earmarked reserves, you will mention that specifically. Coming to non-current liabilities, your borrowings, how you will present, redemption terms, etc., need to be disclosed. Provisions, you are having the disclosures, the items that need to be presented. Borrowings, etc., again, secured, unsecured, you will be giving it separately. Other financial liabilities and other current liabilities, etc. Coming to trade payables, you will show for the micro, small, and medium enterprises, MSME enterprises, you will disclose the principal amount and interest due thereon, remaining unpaid to any supplier at the end of each accounting year. The amount of interest paid by the buyer in terms of Section 16 of the MSME Act, MSMED Act 2006, along with the amount of payment made to the supplier beyond the appointed date during each accounting year. Interest due and payable for the period of delay in making the payment, but without adding the interest specified under MSMED Act. Amount of interest accrued and remaining unpaid at the end of each accounting year. Amount of further interest remaining due and payable even in the subsequent years until such date when they are actually paid. So all this is what you will disclose. Coming to trade payables aging schedule, this is something you will have to do it now, where you give it from the due date of payment, and it is categorized into MSME and others, and disputed dues of MSME and disputed dues of others. Contingent liabilities and commitments, you will disclose it separately. Additionally, amount of dividends proposed to be distributed to equity and preference shareholders for the period. So if the dividend is proposed, but there is no, what you can say, no approval by shareholders, this is the recommended dividend by the directors, you will not provide it, but you will present a disclosure. It is fairly clear even in the Ind ASs that we have studied before. Okay, then if I look at the other ones, additional regulatory information, title deeds of immovable properties not held in the name of the company. This is something which came, I believe, last year or last to last year. So you will have to give the relevant line item in the balance sheet. What is the description and what is the gross carrying value? Title deeds are in whose name, and whether it is in the name of a promoter, director, or a relative of promoter, director, or employee, etc., whatever it is, since when it is held, and why is it not held in the name of the company. So this is something which you will have to give the disclosure of. Okay. Coming to the next one, loans, advances in the nature of granted to promoters, directors, KMPs, severally or jointly, that are repayable on demand or without specifying any terms or period of repayment. You will give the type of borrowers, amount of loan or advances, and percentage to the total loans or advances. CWIP aging schedule is something that has come now. So projects in progress and projects which are temporarily suspended, will disclose that separately. CWIP whose completion is overdue has exceeded its cost, following CWIP completion schedule shall be given. To be completed in how many years and what are the projects. Okay. Intangible assets under development, a similar presentation that follows. Details of Benami property held. Again, we are having cases where you are having the property, but it is not in your name. So where there is any proceedings initiated or pending against the company for holding any Benami property under the Benami Transactions Prohibitions Act 1988. And you shall disclose details of the property, amount, beneficiaries. If it is in the books, then reference. If it is not in the books, then the fact to be stated. This is basically entities which are shell entities where you route the money through various group entities or shell companies, and ultimately you buy the land, where ultimately the intention is to mask the true owner of the property, is to mask the identity of the beneficiary of the property. Where the proceedings against the company as an abettor of the transaction, details shall be provided. Nature of proceedings, status of the same, and company's views on the same shall be disclosed separately. Where you are having borrowings from the banks, disclose whether quarterly returns or statements are in agreement with the books of accounts. Suppose you take a cash credit facility, you have to present monthly financial, what you can say, monthly stock statements, like trade receivables position, trade payables position, then inventory positions. So it is widely noticed that there is a huge difference. There is a huge difference between the data that is presented in the financial statements vis-a-vis what is presented in the banks. In fact, we have come across both the sides that see, when I present the financial data to the banks, I show very high levels of stock, because the intent is to get a high drawing power, a higher borrowing from the bank. But when you are actually filing the tax returns, at that point of time, it is noticed that your stock levels have suddenly decreased. They have fallen considerably. Reason being, at the time of filing your tax returns, your intention is to avoid your taxes. So one of the ways, one of the loopholes these entities probably see is the reduction in the stock, So that is the reason your profits will go down, because basically when your closing stock reduces, your consumption increases, and consumption increases means your cost being charged to the P&L is high, and therefore your net profit goes down. As a result, your tax gets saved. But what is key to notice, you have already submitted the stock statement for March somewhere in mid-April. You would have given to the bank. You are finalizing your financial statement somewhere in July, August, September. Now, when you are finalizing in July, August, September, these results should ideally correlate with the stock statements that you had provided for the month of March. If that doesn't happen, then that is a problem which you will have to communicate, And auditors also have a bearing of this in respect of their audit report as well. So they do review this as part of their audit exercise at each year end. Okay. If not, summary of reconciliation and reasons for material discrepancies to be adequately disclosed. What do you mean by a willful defaulter? If a company is a declared willful defaulter, date of declaration and details of defaults. Who is categorized as a willful defaulter by any bank or a financial institution or consortium thereof. Consortium means a group of banks who give loan, because one bank does not have the risk appetite or the funds to give the loans. So you have 4 or 5 banks coming together to give an advance, a loan to an entity to operate. And now that entity is disclosed as is identified as a willful defaulter, you have to give the disclosures. Okay. Relationship with struck off companies. Companies which are struck off under Section 248 of the Companies Act or Section 560 of the Companies Act, you shall disclose the following details, namely what are investments, receivables, payables, shares held by struck off company, and other outstanding balances to be specified. This is a very huge activity that needs to be done. Okay, so any idea how you do this? Yes, anybody has done this activity or anybody has audited this activity? I presume that you guys are articled or have completed your articleship. This was there even in the last year. Yes. So any idea how are you going to facilitate this transactions with struck off companies? Any idea how this has been done, how this would be audited, and what audit evidence would you have to present? Yes. Any idea? You can just let me know. Yeah. Because only I am speaking, there has been no interaction for close to half an hour. Yeah, good evening, Namrata. Good evening, Tanisha. Good evening. Yes. So tell me. quickly. Okay, all right. Anybody else? Satish, Namrata, Tanisha, any idea how this is actually done by the companies? Transactions with struck off companies. You would be doing an audit of companies, right? Uh, I mean to say, you would be doing audit as part of your activity. If you have, this is applicable to all companies, not only Ind AS, even non-Ind AS companies में ये applicable था. Okay, so and इसमें कोई limit नहीं है. This is mandatory. Okay. So anybody has any idea? No idea? Okay. So what you have to do is you will basically pull out from the master list. You will have master list of vendors, master list of suppliers, master list of customers. Basically all the transaction, all the details you will have. Okay. Master list will include all the vendor suppliers right from inception of the company till date who are there on your records. Okay. So you pull out the master list. Out of that master list, you will then look at whatever entities you have transacted with. It's not necessary that you transact with everybody. Okay. You may have a supplier today. You were not happy. So you have procured, but you were not happy with the quality that he delivered. So you stopped delivering, you stopped buying goods from him. Okay, but he's there in the master. But in the next year, next to next year, you may not have any transaction with him. Okay, so you pull out all the master list of vendors and customers. Out of the master list of vendors and customers, what you are going to do is you will then move on and identify those transactions, those vendors, customers, etc., where you are having transactions. So you, the first level of filter is total parties. Out of that, remove the parties you have not transacted with. तो वो बाहर चला गया. So then you are left with parties you have transacted with. Number one. Now, when you are having parties you have transacted with, typically as part of the vendor creation exercise, you would have obtained their PAN, GST number, etc., etc. So in the PAN and GST number, you will definitely come to know whether that entity is a partnership firm, whether it is a individual, whether a proprietary concern, whether it is a company, private limited, whatever, a firm, an LLP, whatever it is. So therefore, the transaction is whether there are any transactions with companies struck off under section 248 of the Companies Act 2030 or 560 of Companies Act 1956. It is not asking you to give details of transactions with shut down partnership entities, closed LLPs, etc., etc. They are talking only about companies struck off under the Companies Act. So total vendor customer listings, out of that transactions entered into in the current year, out of that you identify the companies, and out of those companies listing, you will have to go on the corporate affairs website, mca.gov.in, and there you will have to, key in the MCA master data is there. So in the MCA master data, when you put in the company's details, you will then get the you will then get the evidence that whether it is active or whether it is struck off. If it is active, so you attach that screenshot for that company and say this is an active company, this is a struck off company, etc., etc. You need to do for each of the companies that you have transacted with. And that database is something which you will then prepare, and there you will identify what are the transactions you have entered into. And if once you have done this Excel sheet or this presentation, whatever you have done, you will then forward this file to the auditors for their verification. So that is how you will basically prepare the data, and you will also verify the data. Okay. You cannot just say that the company has not transacted with any struck off companies. It is not going to work. Okay. Even taking a management representation letter for this is ideally not correct in my humble opinion. This is the way you will have to do it, because you need to have strong evidence to say that the company has not transacted with any of these entities. Okay, so that is your relationship with struck off entities. Okay, fair enough. Coming to the next one, registration of charges or satisfaction with registrar of companies. Okay, so where satisfaction of charges or charges itself you have not registered, or it is not registered within the statutory period, then you will have to explain the reasons thereof. Okay, compliance with number of layers of companies. Okay, so there is a requirement where you cannot have more than 2 layers of parent and subsidiaries. So when you do not have, when you have complied, fair enough. If you have not complied, you will have to disclose that specifically. Additionally, you now have a requirement of ratios: current ratio, debt equity, debt service coverage, return on equity, inventory turnover, trade receivables, trade payables turnover, net capital turnover, net profit, return on capital employed, and return on investment. You shall explain what is there in the numerator, what is in the denominator, and if the change is more than 25% as compared to the preceding year, you will have to give explanations for the same. Okay. Compliance with approved schemes of arrangements like amalgamations or demergers, whatever is there, you will have to explain the compliance. Utilization of borrowed funds and share premium, you will have to mention for what purposes you have taken the funds, have you used it for that purpose or not, and where you have received any fund from any person or entities, including foreign entities, funding party, with the understanding that the company shall, okay, so you are basically a pass-through entity. X has given money to you to lend it to Y. So if you are a pass-through entity, you will have to give details of that loan, advances, and funding. Okay. When a company applies an accounting policy retrospectively or makes a restatement, attached to the balance sheet, a balance sheet as at the beginning of the earliest comparative period presented. This is nothing but Ind AS 8 provisions, which they have specifically given. You have to have 3 balance sheets. You have to have 3 balance sheets. Share application money pending allotment to be classified into equity or liability in accordance with relevant Ind AS. Share application money to the extent non-refundable to be shown under equity, and share application money refundable to be shown separately under other financial liabilities, because it represents an obligation to deliver cash. Preference shares, depending on their nature, shall be classified as equity or as a liability. Disclosure and presentation in that regard shall be applicable to the preference shares. Plain vanilla redeemable preference shares shall be presented under non-current liabilities as borrowings. Disclosure requirements in this regard applicable to the borrowing shall be applicable as it is. Mutatis mutandis means as it is applicable to borrowings, same disclosure requirement shall be applicable to preference shares. Compound financial instruments shall be split into equity and liability components and presented under relevant heads. Regulatory deferral accounts, this is something which is not probably there in your syllabus. I think it is Ind AS 114 or something like that. I'm not very sure. Okay, this is specifically for government entities where you have regulatory deferral accounts. In the case of electricity, nuclear power companies and all, we have seen this. I'm also not very much aware of this. Okay, so I don't count myself because I'm not exposed to this area of practice. We don't have these kind of entities. But yeah, so where you have regulatory deferral account balances, it shall be presented in accordance with the relevant Indian accounting standards. Coming to your profit and loss, this is the standard format of the P&L that is there. So you will present the profit and loss and the statement of other comprehensive income. You can look at the heading, they have maintained statement of profit and loss. Whereas if you look at foreign companies, it is not statement of profit and loss. They call it as statement of total comprehensive income. So on one side, they have statement of financial position, statement of total comprehensive income, whereas here we call it as the old name only, that is the balance sheet and the statement of profit and loss. Okay. And you will have the P&L initially, followed by the other comprehensive income. Total of 1 and 2 is total comprehensive income. So that is something which you have seen. So all this is something which you are already aware of. Your other comprehensive income will be classified into items not reclassifiable to profit or loss. So changes in revaluation surplus, it is not reclassifiable. remeasurement of defined benefit plan, actuarial gains or losses which are there under Ind AS 19, non-declassifiable, equity instruments through other comprehensive income, where you have taken an irrevocable choice of taking your fair value movements of equity through other comprehensive income. That point of time, it will be present here as fair value reserve, and it will not be reclassified to the P&L. Fair value changes relating to own credit risk of financial liabilities designated at fair value through P&L. Share of other comprehensive income in associates and joint ventures to the extent not reclassifiable to the P&L. Shares of other comprehensive income in associates and joint venture to the extent not to be classified into, I don't know, this is a repeat, I think. Share of other comprehensive income. Yeah, it looks to be the same. Others. Okay. Coming to items reclassifiable, it could be exchange differences, basically FCTR. Once you dispose of a foreign operation, then the FCTR will be reclassified to the profit and loss. Debt instruments through other comprehensive income, you will reclassify it. Effective portion of gains and losses on hedging instruments. Once the instrument is hedged, then you will move this to the P&L. Share of other comprehensive income in associates, joint ventures, etc. to the extent reclassifiable to the P&L and others. Then you will disclose employee benefits expenses separately, showing salaries, wages, contribution to social welfare funds, share-based payments, and staff welfare expenses. You will show depreciation, amortization separately. Any item of income or expenditure which exceeds 1% of revenue or 10 lakh rupees, whichever is higher, you will disclose it separately. In addition to the consideration of materiality, you will present it separately in the statement of profit and loss. Interest income, expense, dividend income, net gain or loss on sale of investments, foreign currency transaction and translations, payments to auditors to be disclosed separately. Companies covered under section 135, this is your CSR spend, which will be shown separately, and items of an exceptional nature, you will present it separately. Okay. Then coming to undisclosed income, income which has been surrendered or disclosed under the income tax assessments, you will present it separately. CSR disclosures are there, standard disclosures. Details of cryptocurrency or virtual currency, which has become a latest fad to invest in. So you will be giving the details of what is the amount invested, held at the reporting date, profit or loss on the transactions involved, and deposits from any person for the purpose of trading or investing in crypto or currency or virtual currency. Changes in regulatory deferral account balances presented in line with the relevant Indian accounting standard. Okay. So that is by and large your schedule 3 that is there. Okay. Coming to your consolidated financial statements, largely the same. Only thing is, what is new is you will have the profit and loss split into non-controlling interest as well as attributable to the owners of the parent. So that split needs to be given. Non-controlling interest to be presented separately from equity of the owners of the parent. Okay, it will be under equity but separately. Investments accounted for using the equity method, that is investment in associates and joint ventures, you will present it separately. Okay, so this is something which you are already aware of. Okay, so that is by large your schedule 3 that you will stick to. So you will have to follow the format, yes, but at the same time, if you feel this is the bare minimum requirements which are there in schedule 3. Beyond this, you can definitely go ahead and disclose, but in India, we are fairly satisfied with यार इतना कर लोगे काफी है ना तो इतना ही करेंगे इससे ज्यादा हमें नहीं करना है. Okay, choice is yours, but yeah, you are always encouraged to make more disclosures in your financial statement so that it helps the investors. It helps the investors. Okay, coming to characteristics of good financial statements, what is the requirement? Okay, first one is true and fair view of the affairs. It must speak for the business. Okay. There should not be wide deviation between what is presented and what is the actual affairs of the business. Okay, so that will include not only the profit and loss item when I talk about the true and fair view of the affairs, it could also mean to include account balances. It could also mean to include account balances as at a particular date. Like for instance, you have received money from a particular entity. Okay, now that money should have gone as part of the payments received from the customer. He is a customer. But instead, what you have done is you have routed that money to a advance received from the customer. Okay, and it is sitting under other current liabilities. Okay, it should have been knocked off against the outstanding balances, but it is sitting under advance received from customer. So therefore, this is not representing a true and fair view of the affairs of the enterprise. So therefore, the first important thing is it should present true and fair view. Second is it should provide relevant information for the period it is presented. There is no need for you to present past data of more than a couple of years. Okay, current and previous जो 2 सालों का data दे रहे हैं, that is more than sufficient for us to present. Okay, what is important is when I present it, that comparative is going to give an idea of the growth of the company, how it is, direction they are leading it into. Coming to the next one, understandability. For the user to make sense, the financial statement should be readable and lucid to digest. Even a layman should be able to read the same. I partly disagree with this because if I look at my current Ind AS financial statements, layman छोड़ो कई चीजें तो हमें भी समझ में नहीं आती है. We ourselves are now able to understand, interpret financial statements because we are professionally involved in the financial statements understanding. Okay, what you are studying is a very high level understanding of the standards, so you will be able to understand. But you ask an engineer to read the disclosure on hedging operations under financial instruments given in the financial statements, do you think that engineer will be able to comprehend what is written? Forget financial instruments. Take simple deferred tax computation. Don't put it to anybody. You put it to people of the income tax department and ask them, sir, can you understand what is deferred tax? वो बोलेंगे deferred tax liability, a liability है अभी हमको दे दो. I mean, we have had cases where you have people from the department coming out with such an understanding of the financial statements. They looked at deferred tax liability and then they have raised a demand notice for that, saying that you have a deferred tax liability in your balance sheet. Please arrange to pay for the same and consider this as a demand notice under section 156 of the Income Tax Act. I mean, where are we coming from? Are you even so incapable to read the financial statements? Unka fault nahi hai. It is the complexities which are involved. So therefore, making the financial statements understandable is definitely required. But the fact is there are so many complexities that a layman may be able to read, but he will definitely not be able to comprehend the financial statements. Okay. Be consistent in applicability of accounting policies and estimates. Do not make any changes, major changes. Regulatory compliance, you have to ensure you comply. And universality, they should be comparable within the industry as well as outside. So they should look similar lines. For example, if they are manufacturing steel. Likewise, financial statements of a company manufacturing steel in India to be comparable to those based out of the US, they should be comparable. Okay. They need to have the above characteristics, have brought the accounting bodies world over to come together to have a common standard set for better integration and harmonization. Okay. So best practices, one is compliance. It is a compliance related requirement. So we have to ensure we comply. You have to give complete disclosure. Now, if you are giving a statement, you may have seen it in your accounts. Okay, this is most probably something that happens with small entities. I'm not saying that it's right or wrong, but you know, कई बार अनजाने से गलतियां हो जाती है. Many times you write balances of debtors, creditors, loans and advances are subjected to reconciliation and confirmation. इसका मतलब एक बार जरा सोच समझ के आप बोलोगे, you know what you are saying. We have done this much. ये सही है कि गलत है ये हमें नहीं पता. It is subjected to reconciliation and confirmation. That means you are presenting a number in the financial statements without taking responsibility of the completeness of that. Okay. You are saying that अच्छा ये डेटा है बट इसका रिकंसिलिएशन करना पड़ेगा कस्टमर के साथ या वेंडर के साथ. यू आर प्रैक्टिकली स्पिलिंग इट ओवर ऑन द फाइनेंशियल स्टेटमेंट्स. That means you are only saying that I am not going to take responsibility for this because it is subjected to reconciliation and confirmation. What were you doing for the entire year? Why did you not reconcile in the entire year? Why do I have this comment in my financial statements? Why do I have a situation where confirmation is not received from my vendor or customer? If it is a good relationship, if it is a good relationship between your supplier as well as your customer, there will not be any problem in exchanging the balances because that is the right way where you can ensure completeness of the data which is presented. Okay. So these balances may or may not be appropriately stated as well as raising questions regarding the appropriateness of the audit process. Tell me, any of you, okay, Mohammed or Viraj or Satish or Namrata, Shruti, have you come across these statements in the financial statements of companies? Be honest, I have come across. Okay, let me be very open. I have come across with this. Yes. Have you come across with this? Have you come across this statement? Yeah. Balances of debtors, creditors, etc. are subjected to confirmation and reconciliation. Have you come across this? Yes. एक और रहेगा, inventory is as certified by the management. Yeah, देखा आपने? Inventory is as certified by the management. Yes. Inventory is computed at cost. Inventory is disclosed at cost and is based on certification by the management. ये हम लोग लिखते हैं financial statements में. Have you seen this? Yes. Have you seen this in the financial statements? We are doing such kind of blunders in our financial statements. Why are you even certifying a financial statement as true and fair when you have a disclosure saying that inventory is as certified by the management? Then what is it that you have done as an auditor? What is it that you have done as an auditor? As an auditor, if you see, I think SA 501 or SA 500 series mein, there is a special standard that deals with inventory audit. And there it's mandatory that the auditor is present for the inventory count at the end of the financial year to ascertain appropriateness, existence of inventory and valuation of the inventory. It is mandatory for the auditor to do that verification. He should not say that inventory is based on management count and management estimate and management verification when you as the auditor are certifying the financial statements. Just imagine your financial statements, your audit report, you certify true and fair view and कहीं disclosure में डाल देते हैं inventory is as certified by the management. और कहीं लिख देते हैं कि debtors and creditors are subject to confirmation and reconciliation. I mean, where is this coming from? Disclosure डालने के लिए कुछ भी disclosure डाल सकते हो. It's not possible. It's not possible, right? And therefore, you have to ensure that this practice stops. See, you are at the cusp of clearing your CA final examination. Okay. Tomorrow, you guys are going to be the torch bearers of this profession. Okay. And so will the batch that proceeds after you, that succeeds after you. We are capable of bringing a change in the attitude that is currently being followed. If you become a part of the system, then this system will continue to exist. If you do not want to become part of the system, then you are supposed to not follow such practices. And you are supposed to speak against those practices. Okay. I know it is a tough ask for freshly qualified chartered accountants to discuss so much. But the fact is, if I have to maintain the integrity of the profession, if I have to maintain the integrity of the signatures that I do, then such kind of disclaimers, such kind of comments, such kind of, notes, they are not enhancing the financial statements. They are only making it they are only making it more difficult to understand. They are saying, what is the auditor audited then? Okay. So when you qualify, please ensure that these practices are stopped. Many times you would be doing it, I don't know. You are also in the part of the articleship. So you would be a part of the system right now. But as you qualify, as you clear, you may go to a big four. You may probably work in the industry. Some of you may intend to start your own practice. When you do this, it is your job to ensure that your client prepares the data as you want it. Okay. Struck off companies. I haven't seen many auditors really going deep into verification of transaction with struck off companies. Management representation ले लेते हैं, and after taking the management representation, they just say that there are no transactions with struck off companies. Is a management representation a substitute for an audit process? Is it a substitute for an audit process? Answer is no, it's not. But we do it. We do it without proper audit evidence. You call it ignorance. You call it our mistakes. You call it as our ignorance of the audit process. Yes. So that is the reason my humble submissions in this regard is, you may end up losing clients. You may end up being called as a stickler of rules and regulations. You may end up being called as a person who is bookish, a person who does not know practical life from academic life, a person who is sticking to rules and not understanding practical difficulties. See, the whole problem with the industry is, they say that he does not understand the business. ये कभी कभी आते हैं ना, इनको समझता है, इन्हीं को सब आता है, बट बिजनेस में तो हम बैठे हैं. That is the kind of language which we listen to, and that is in fact some of the things which we also speak as part of the industry. Definitely, I do admit that. But the problem, the fact is, if you are a stickler for rules and regulations, you may lose a client one time, you may lose a client twice, thrice, but there will come a client who will understand and appreciate your methodical process, and they will have a long-term association with you. Okay. So ensure that you do not commit the same mistakes which are there as examples here. You have to chart your progress based on your own integrity levels. Okay. See, understanding the business, all of that is different. But apart from that, you have to ensure that these things are maintained. These things are maintained. Okay. So coming next, draft your notes accounts. Okay. Be simple and specific. Again, ensure there are no vague or ambiguous notes. Draft your accounting policies in simple and plain English. Easier said than done. किसी के पास time नहीं होता है, but easier said than done. Make your policies clear and specific. No vague or ambiguous notes. जैसे ये वाला. Okay, like this one, subjected to reconciliation and confirmation. You know what does this mean? If it is a debtor, do you not know how many sales you have done? Do you not know how much collection has come? Then why are you saying debtors are subjected to confirmation and reconciliation? Yeah, straightforward transaction. Customer के case में, I mean supplier के case में, at the most there may be transactions at the end of the year where you have purchased but goods have not yet received, have not yet reached your premises. Apart from that, there should not be any reason why you have to doubt it. Okay. So do not put any vague or ambiguous notes with no further information or explanation. Reduce generic disclosures and focus on company specific disclosures that explain how the company applies the policies. Okay. All right. So that is one. Then you move on to transparency. So be very open in your disclosures. Do not hide the data. Okay. Transparency shall provide useful additional information and substantiate your decision or judgment. Materiality, this is a very big shield that industries use. Okay. You go to them with an observation, they will say, Kitna material hai yaar? It is not material, just forget it and do the audit. Okay. I mean, that is the first step that industries use. Okay. The lack of clarity in how to apply the concept of materiality is perceived to be one of the main drivers for overloaded financial statements. First of all, you have to use materiality effectively. I have seen financial statements jahan pe you have company where crores of turnover is there and other expenses may they are writing staff, not staff welfare. Other expenses may you are having printing and stationery 5,000 rupees and some other expense 2,000 rupees. Turnover is in crores and other expenses you are having these small things. What are you trying to say? Club all of them into one and say that these are all my other expenses. That's it. That is how you present your financial statements. You believe you are giving a lot of transparency and detail, but uska kuch maine nahi rakhta hai. For a company with a turnover of 200 crore rupees, what is the matter if you club items worth say 10 lakh or 15 lakh or 20 lakhs? It's not a big deal. You just have to club and present it. The reader of financial statements is interested in material items, not in these small items. Okay. So that is one important thing you have to ensure. Okay. Information should be disclosed only if it is material. Materiality is with respect to the nature as well as the amount. Your materiality assessment is the filter in deciding what information to disclose and what to omit. Once you have determined which specific line items require disclosure, you should assess what to disclose, including how much detail to provide and how best to organize the information. Okay. Integration of notes, they are largest portion of financial statements. Effective tool of communication. Group the notes into categories, place the most critical information more prominently. Integrate your main note of a line item with its accounting policy and any relevant key estimates and judgments. Okay. Disclosure of material accounting policies, you will have to disclose. And finally, key estimates and judgments and an integrated approach. Like right now, we are going not only into the numbers and the notes, but we are also having CSR reporting, business responsibility reporting, ESG, the buzzword that is there for financial reporting, environment, social, and governance. Okay, you have this buzz which is going around everywhere. We need ESG professionals. We need ESG professionals everywhere. Yes, so ESG is also something. So integrate, develop an integrated approach in your financial reporting. Okay. Consider annual report as a whole and deliver a consistent and coherent message throughout. Present outside the financial statements, environmental reports and value-added statements, even though the reports and statements are presented outside, are not within the scope of Ind AS, they are not out of the scope of regulations. Okay, so that takes care of broadly your characteristics, nature of financial statements, etc. Okay, so any doubts so far? Any doubts? We have covered in brief what is Schedule 3, Division 2, balance sheet, profit and loss. We discussed some key action items, how to do those disclosures. And then we saw the characteristics of financial statements, what is required, what is not required. All of this we have seen. So with that, we are kind of done with the theoretical part of this standard. Are we okay? Anybody has any doubts? Anybody has any doubts or difficulties? Yeah. Namrata, I did not understand action you have taken after knowing this. Yeah. I am not sure what you said. Okay. Yeah. Anybody has any doubts? No doubts? Then I shall proceed further. Yes. Any difficulty, guys? Oh, yes. Why not? You can definitely refer notes of peer companies. There is no doubt. In fact, many times when we have been preparing financial statements, I do refer to the way the financial statements are prepared of peer companies because it gives a better understanding of how to present the data. Yeah. So you can definitely do that. So we had clients who were in the hospitality industry. So we wanted to understand how to present certain data, certain information, how best we can present. So we did refer to companies like Indian Hotels Companies Limited, IHCL. Okay, so we did refer, and basis that we presented and improved the way financial information was presented. Yeah, so it's perfectly acceptable. You can refer it. Okay, because it's in public domain. आप कुछ चुरा नहीं रहे हो. You are only wanting to improvise your presentation. You are not stealing their data. And वो stealing क्या? It is available in public domain. So you just refer it, do the verification. I mean, apply it based on their presentation and continue. So it's perfectly fine. All right. Okay. So now coming to the questions. So we have a couple of case studies which are there. Okay. We will do these case studies. There are a couple of questions also. So basically, when we talk about analysis of financial statements, largely it is a chapter that is a culmination of what all you have studied. So you started up with Ind AS 1. I think you started off with applicability of Ind AS. That was the first class that you had, introduction and applicability, the phase-wise applicability. After the phase-wise applicability, what you had was Ind AS 1, presentation of financial statements, preparation and presentation of financial statements. Then you moved on to the various standards that you studied. Then you moved on to the various standards that you studied. And after you study the various standards, you can then move on to the uh, what you saw, Ind AS 8, 10, prior period items, accounting policies, estimates, etc. वो सब पढ़ के we came to last two topics, Ind AS 101, because now you are better placed to understand the transition. I hope you have understood the transition impacts. And now we are doing Ind AS, analysis of financial statements, where it is a culmination. This is a summarization of what all you have studied over the past couple of months. Okay. So I believe that this is a particular chapter where your expertise will be tested in the area of financial reporting. तो वो expertise देखेंगे क्या है? You have to give your comments as a professional consultant. Yes. So with that, we shall see 2 to 3 case studies today. And after that, I will see if I can put anything onto homework for you. And after that, we'll check what is there. Okay. All right. So coming to case study 5, let us pick this up. Deepak, this is an RTP November 2020 question, which is now incorporated in your study material. Yeah, people tend to do Control C, Control V in your financial statements. वो चलेगा नहीं because कई बार क्या होता है कंपनी का नाम भी आ जाता है जहां से उठाया है, right? So हो जाता है. So be very careful. Okay. All right. Deepak started a new company, Soft Bharati Private Limited, with Iktara Limited, wherein investment of 55% is done by Iktara and rest by Deepak. Voting powers are to be given as per the proportionate share of capital contribution. The new company formed was the subsidiary of Iktara Limited. So Soft Bharati is a subsidiary of Iktara with 2 directors, and Deepak eventually becomes one of the directors of the company. A consultant was hired and he charged 30,000 for the incorporation of the company and to do other necessary statutory registrations. 30,000 is to be charged as an expense in the books after incorporation of the company. Quickly, you guys are experts in Ind AS. Okay. 30,000 was pre-incorporation expenses. Okay. Pre-incorporation expenses, matlab drafting of the prospectus, memorandum articles, banana, checking the existence of the name, then incorporating the company, ensuring that capital is introduced, ensuring that subscribers to the memorandum, they have signed the memorandum and articles of association. All these things are done prior to incorporation of the entity because these activities will then give rise to the entity. My question to you is this 30,000 rupees, should it be charged as an expense after incorporation of the company or should it be capitalized? Should it be capitalized as a pre-incorporation expense item like how we used to do it earlier? Okay. Yeah. Tell me. Come on. बोलो. Tell me. What do you do? Okay, I'm waiting for other answers. You guys have studied Ind AS, तो सोच समझ के जवाब दो. Okay. What do you do with pre-incorporation expenses? What do you do with pre-incorporation expenses? Okay. Which standard requires you to capitalize it? All of you are saying capitalize. Please tell me under which standard are you capitalizing? Yeah. अभी अभी हमने पढ़ा है. Right now we have studied that Schedule 3 does not prescribe treatment, it prescribes only presentation. Treatment is under respective Ind AS. My question to all of you who said it should be capitalized, please tell me under which standard are you going to capitalize pre-incorporation expenses? I got one answer. Yes. Bolo. Which Ind AS do you want to capitalize? Yeah, that is why I said think and answer. सोच के बोलो मुझे आप कौन से इंडेक्स के अंडर कैपिटलाइज कर रहे हो. इज इट प्रॉपर्टी प्लांट एंड इक्विपमेंट जो आप इंडेक्स 16 लगा रहे हो? इज इट अ बायोलॉजिकल एसेट फॉर विच यू आर अप्लाइंग इंडेक्स 41? इज इट इन्वेस्टमेंट प्रॉपर्टी फॉर विच यू आर अप्लाइंग इंडेक्स 40? Is it an intangible asset for which you are applying Ind AS 38? Come on, guys. Bolo, what asset it is? What asset it is? Is it Ind AS 16? Which item of property, plant, and equipment has come into existence because of 30,000? Did you buy furniture, table, chair, computer, fan, tube light, air conditioner, machinery? What did you buy? जो आप बोल रहे हो इंड एस 16 के अंडर कैपिटलाइज होगा. यस. फॉरगेट एवरीथिंग. कंसेप्चुअल फ्रेमवर्क. We saw the definition of an asset. Yes or no? Yes or no? We saw the definition of an asset. Yes. याद करो asset का definition क्या है? Yeah. Try to recollect. What is the definition of an asset? मैंने ही पढ़ाया था ना आपको. I had only made you to study the conceptual framework. Yes. What is the definition of an asset? Elements of financial statements. Come on. What is asset? An asset is a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has a potential to produce economic benefits. याद करो ये हमने पढ़ा था. We had studied this somewhere. When did we study? September. I think we studied it in September or October. Yes. Yes, I think we studied it in September or October, right? अब मुझे बताओ, what economic benefit are you going to get out of pre-incorporation benefits? What resource it is? First of all, you tell me, is it an economic resource? Is it an economic resource? नहीं है वो resource. It's not a resource. It has given you a company, but वो अपने आप में resource थोड़ी ही है. You have just formed the company. अब बैठ जाओ ऐसे ही. Will you start earning money out of it? Answer is no. You are not going to get any benefit out of it. It is not meeting the criteria of an asset as laid down under the conceptual framework. It is not an intangible asset under Ind AS 38. It is not a tangible asset under Ind AS 16 or 40. कुछ नहीं है वो. It is just an expense, and therefore rupees 30,000 is to be charged as an expense in the books after incorporation of the company. Treatment is correct. Treatment is correct. It has to go as an expense. There is no second thought about it. आप उसको खर्चे में डाल दो. But sir, we used to amortize it earlier under the Income Tax Act. वो deferred tax impact आएगा उसका. You capitalize it under income tax and then you amortize it 1/5, 1/5, 1/5 over the Income Tax Act. But here you have deducted it immediately. So यहाँ पे carrying amount is 0, but tax base will be there. So because of the carrying amount and tax base differences, and since it is a temporary difference, it gives rise to a deferred tax implication. It gives rise to a deferred tax implication. That's right, Satish. Okay. So therefore, deferred tax implication is there, but this is not an asset. Do not treat it as an asset. Okay. So Zarara, pull yourselves together. Okay. You have many cases ahead. So I will ask you and you have to give me the answers. Okay. You have all studied Ind AS. So do not make mistakes now. Okay. This is a test of your understanding of the standards. Approach it like that. So you guys are one down. Okay. You guys are already one down. Let us now be very alert in the coming, what you can say, coming items. An accountant was hired at the time. Okay. The company Soft Bharati was incorporated on 1st April. The financials of Iktara Limited are prepared as per Ind AS. Okay. So I have Iktara Limited. Soft Bharati is a subsidiary of it. Iktara Limited follows Ind AS. So tell me now applicability. Tell me now applicability of Ind AS. Is Soft Bharati also having to follow Ind AS? Is Soft Bharati also required to follow Ind AS or not? Should Soft Bharati follow Ind AS or not? बोलो यार. Yes, because the parent follows Ind AS, so Soft Bharati also should report as per Ind AS. ठीक है, तो अभी करते हैं. All right. An accountant who was hired at the time of company's incorporation has prepared the draft financials. So he has given the draft financials to you. Revenue from operations, other income, expenses, you have purchase of stock in trade, increase or decrease in stock, employee benefit expense, depreciation and other expenses, giving you profit before tax, current tax, deferred tax, total tax expense, profit for the year. Balance sheet, you have equity and liabilities, shareholders funds, non-current liabilities, current liabilities. Asset side, you have non-current assets and current assets. My question to you, Are the balance sheet and profit and loss account presented? Are they in line with Schedule 3 or not? Are they in line with Schedule 3 or not? Not consolidation purposes only, Satish. It is to be followed even on a standalone basis. Because once Ind AS is applicable to a company, it becomes applicable to all the group, all the entities forming part of the group of that company. तो सिर्फ consolidation purposes के लिए नहीं है. It is applicable even for the separate financial statements. Do not say that I will prepare as per AS regime for regular and for consolidation purposes I will follow Ind AS. गलत है वो. It is not right. You have to follow Ind AS because your parent is following Ind AS. You may have a different accounting treatment of a particular item in separate financial statements for which you will have to align with the parent. Like for example, same inventory, parent may follow weighted average, you will follow FIFO. So you will have to align the inventory valuation as per weighted average because you are consolidating. But you cannot say that I will not follow Ind AS. आपको Ind AS separate financial statements के लिए भी follow करना पड़ेगा. You have to follow Ind AS for separate financial statements. There is no ifs and buts about it. Okay. Coming next. Are these financials as per Ind AS? Answer is no, they are not. Because the statement of profit and loss account does not include other comprehensive income. See, there should be other comprehensive income. है क्या यहाँ पे? It is not there. Second, balance sheet. We should start with non-current assets, current assets, then you are having your equity, and then you have non-current liabilities and current liabilities. यहाँ पे they have followed the old division 1 of the schedule 3, whereas they should have followed division 2. So not as per division 2 schedule 3 of Companies Act. Okay. All right. That's right. Absolutely right. Okay. ठीक है. So that is the first observation. Okay. Additional information of Soft Bharati Private Limited. तो अभी ध्यान से we will study one by one and I will not read the entire question. We will read one adjustment, look at the impact. Any correction is there, we will do it immediately and then we will continue the problem. Because I read it again, then I come back, then I again do it. It is a waste of time. Okay. So now, additional information of Soft Bharati Private Limited. Okay. Deferred tax liability of 6,000 is created due to the following temporary difference. Difference in depreciation amount as per income tax and accounting profit. So deferred tax, you have adjustment 1. Okay. Tell me, is difference in depreciation a correct ground for creating deferred tax liability in line with Ind AS 12? Is it a temporary difference? Is it a non-temporary difference? That is the first question. Is it correct to make a DTL in this case? Yes. Is it correct to make a DTL in this case? They are saying it is due to temporary difference between the carrying amount and the tax base of depreciation. Okay, so is it correct to make a deferred tax provision on account of this? Quick. Don't read second adjustment. Just stick to adjustment 1. Okay. Is it correct to recognize a deferred tax impact on account of this? That is okay. That is fine. Okay. Difference in depreciation amount, that is okay. But broadly speaking, are we in line with the understanding that DTL has to be created? Answer is yes. It is correct. They have to recognize a deferred tax. They have recognized a deferred tax. Computation के बारे में हमने अभी तक बात नहीं किया है. We have not talked about computation. So computation we will see it later. But as of now, is it justified to recognize a deferred tax implication? Answer is yes. बस इतना काफी है. This is enough. So I am having Deferred tax liability 6,000. Corresponding debit should have gone to the profit and loss account. So you can see here, I am having 6,000 debit to the P&L. I am having 6,000 debit to the P&L. We'll come to the calculation now. We'll come to the calculation now. There is only one property, plant, and equipment in the company whose closing balances are as follows. Property, plant, and equipment 1 lakh. So this is my carrying amount. As per Income Tax Act, this is my tax base. You remember these terms, carrying amount and tax base. I hope you remember. So carrying amount is greater than the tax base of an asset. So what should be created? A deferred tax liability should be created. So the difference is how much? 1 lakh minus 80,000 multiplied by the tax rate. So this is equal to 20,000 into. You should be given the tax rate in the question. It is 30%. Okay. So 20,000 into 30%. So that gives you 6,000. This 6,000 is exactly what we have just now calculated. This 6,000 is exactly what we have just now calculated. So therefore, am I justified in doing this deferred tax provision? Yes. Is the deferred tax provision of 6,000 correct? Bolo yaar. Yes. Sumit, Satish, now that you have read adjustment 2, do you believe that 1 and 2 are correct? Yes. All right. Fine. Great. Sumit, balance sheet approach ही है अभी. So are you convinced? Yes. Tanisha, are you able to follow? Mohammed, are you able to understand? Yes. Where are the others? Mansha, Viraj, Shravani, are you able to understand? Yes. I hope I pronounced your name correctly. Yes. Shruti, are you guys able to follow? Yes. All right. Fine. So let us proceed further. So 1 and 2, baat theek hai. There is no adjustment required. They have filhal given correct adjustment. So there is no comment that I am passing. Okay. Pre-incorporation expenses are deductible on straight line basis over the period of 5 years as per Income Tax Act. However, the same are immediately expensed off in the books. Okay. So therefore, I am having pre-incorporation expenses appearing as an asset in my income tax, appearing as an expense, as an asset under income tax. I am amortizing it over a tenure of 5 years. But yahan pe I am not amortizing it. I am expensing it out immediately. So, ठीक है. But is this giving rise to a deferred tax implication? Is this giving rise to a deferred tax implication? Answer is yes, it is giving rise to a deferred tax implication. It is giving rise to a deferred tax implication. So, carrying amount is 0. Tax base. What is my tax base? See, my tax base will be expense was 30,000. 1/5 I have amortized. So 30,000 by 5 is 6,000. So 30,000 minus 6,000. 24,000. Okay. Okay. What I'll do is I will present the solution here. The notes that I'm writing. So it becomes clear. The hodgepodge presentation can be avoided. Okay. Case study 5. Adjustment 1 and 2. No adjustment required. Okay. Now we are doing adjustment 3. Pre-incorporation expenses. And here I am having carrying amount, tax base. Carrying amount is 0. Tax base is 30,000 minus 1/5 of that. So that gives you 24,000. So now my pre-incorporation expenses is 24,000 rupees tax base, and this is 0. So carrying amount is less than that of the tax base. Carrying amount is less than that of a tax base. So this is an asset because it has a debit balance in the tax records. So therefore, carrying amount is more of an asset, gave rise to a DTL. So carrying amount is less of an asset. This gives rise to a deferred tax asset. This gives rise to a deferred tax asset. Therefore, DTA is equal to 24,000 into 30%. So that is 7,200. Absolutely right, Satish. Okay, so this is 7,200. Tanisha, are you there? Travani, are you there? Mansha, are you there? Yeah. Okay, perfect. So deferred tax asset should be 7,200. What will be the entry for this? What will be the entry for this? The entry for this is going to be DTA account debit to profit and loss. Why P&L? Sir, the expenses have gone to the P&L now. The expenses have been debited to the P&L. So the deferred tax implication also will go to the P&L. So DTA account debit to P&L. So coming to our question, we are having adjustment 3. This is a DTL, whereas what was created was a DTA. So minus 7,200. We can net it off, assuming that it is under the same governing statute. So minus 7,200. And here also I will have adjustment 3. A credit to the P&L, so minus 7,200. Minus 7,200. Are we able to understand this? Yes. Are we able to understand this? Yes. Anybody has any doubts here? So adjustment 1 is done, 2 is done, 3 is done. Adjustment 1, 2, and 3. Okay, coming to adjustment 4. Current tax is calculated at 30% on PBT, 3,55,000, without doing any adjustment related to income tax. Sir, how adjustment 3 is an asset? Yeah, how adjustment 3 is an asset, or how it is a deferred tax asset? What are you asking? So basically, see, normally the way I look at it is how it is an asset. Let me explain. See, it is pre-incorporation expenses debit to bank 30,000. 30,000. So debit balance है ना? So I just recollect it as an asset. ठीक है? Okay. I just recollect it as an asset. So now the treatment of this in the books, you write it off fully. So P&L account debit 30,000 to pre-incorporation expenses. You cannot create it as an asset. Okay. Coming to tax, you are writing off only 1/5. So P&L account debit to pre-incorporation expenses 6,000. Okay. So this is what you are going to do. So it remains as a debit balance. That is why I loosely call it as an asset. That is why I loosely call it as an asset. Okay. All right. So that takes care of his query. Prashant Kumar Shukla. Yes. Coming to the next one. Current tax is calculated at 30% PBT. Okay. Coming to adjustment 4. PBT is equal to 3,55,000. Therefore, tax is equal to 3,55,000 into 30%. अगर आप करोगे, you should get 1,06,500. If you do this, you should get 1,06,500. Look at your question. Do you see short-term provisions 1,06,500? And if you look here, current tax is 1,06,500. That is 3,55,000 into 30%. Now, is this correct? Let us read the adjustment. The correct current tax after doing necessary adjustment of allowances related to income tax comes to 1,25,700. My question to you is, what should be the current tax expense? Should it be 1,06,500 or should it be 1,25,700? क्या होना चाहिए? What should it be? Should it be 1,06,500 or should it be 1,25,700? याद करो वो दिन जब हमने Ind AS 12 पढ़ा था. In that we had studied what is the definition of current tax. So in the definition of current tax, what is included? You will have to now tell me. Should I take 3,55,000 into 30% as my current tax, or should I take 125,700 as my current tax provision? Come on, tell me, quick. Yes, two answers. Okay, third. All right. Next. Prashant, you got your clarity on your question, on your earlier question? Yes. Come on, guys. Okay. Two people are saying 1,06,500. Two people are saying 1,25,700. What about the others? बाकी लोग क्या बोलते हैं? Okay. All right. Majority are saying 125,700. सबको याद दिलाना पड़ता है कि हमने क्या पढ़ा था उस दिन. Okay. What is current tax? Amount of income tax payable or recoverable in respect of taxable profit or tax loss. Means what is this? Taxable profit and tax loss means what is taxable profit? Profit or loss for a period determined in accordance with applicable tax rules. मतलब you will not do 3,55,000 into 30%, my friends. वो गलत है. That is not as per the tax rule. That is your accounting profit. But to your accounting profit, you will add certain items, you will deduct certain items, you will make some adjustments. So therefore, your tax provision is not going to be 3,55,000 into 30%. If it was 3,55,000 into 30%, there would be no requirement for Ind AS 12 as a standard in the first place. Why did I have 3,50,000? Why did I have Ind AS 12? To make a bridge between your profit before tax into the rate, to bridge it with the current tax provision and deferred tax provision. That was where we had started our discussion in Ind AS 12 in the first place. So those of you who gave the answer as 1,06,500, वो ठीक नहीं है. वो ठीक नहीं है because that is based on accounting profit. Your current tax you don't pay on accounting profit, you pay on taxable profit, and therefore your tax provision should be on the basis of 1,25,700 and not 1,06,500. Okay, padho sab, everybody study what is being told to you. Okay, so therefore this will be 125,700 and here also 125,700. All right, perfect. So that takes care of adjustment 4. All right, coming to the next one, adjustment 5. After the reporting period, the directors have recommended dividend of rupees 15,000 for the year ending 31st March X2, which has been deducted from reserves and surplus. Dividend payable of 15,000 has been grouped under current liabilities along with other financial liabilities. Is it correct? Is it not correct? If correct, why? If not correct, what is correct and why? Okay, chalo. Yes. Yes. All right. Fine. I got one answer. What about the others? Tell me, is the treatment correct? Absolutely right. All of you have given the right answer. So 15,000 is recommended dividend. It is not approved by shareholders. So all you have to do is give it a note, but do not give any adjustments. And therefore, and this is adjustment 5. You will pass the entry. Where is it included? Other current liabilities. So other current liabilities से निकालना पड़ेगा हमको. Other current liabilities debit to reserves 15,000. 15,000. Okay. So coming to the question, other current liabilities, remove 15,000 from here and add 15,000 here. Add 15,000 here. Acha, 2,27,500 plus 15,000 if you do, it comes to 2,42,500, which is exactly the profit for the year that they have given. होना भी चाहिए because this is the first year of Soft Bharati Private Limited. Okay, this is the first year of Soft Bharati. So whatever is the profit for the year, that should be reflected in the reserves. So therefore, it is matching. You can cross check and it is working well. So this is adjustment 5. Okay, this is adjustment 5 and this is also adjustment 5. Okay, wo profit is right or wrong is a different question, but right now the issue is 2,42,500 should come there, which is now coming there. Okay, so 4 and 5 is also done. Coming to the next one, there are government statutory dues. There are government statutory dues amounting to 15,000, which are grouped under other current liabilities. Which are grouped under other current liabilities. क्या करना है इसका? Why this data is given? Why this adjustment is given? So my other current liabilities right now is 30,000. Okay, fine. बोलो बालक बालिके लोग. Why they have given that adjustment? ऐसे ही सर देने के लिए दिए हैं, right? I'll give you a hint. It is related to Schedule 3 format. It is related to Schedule 3 format. Now you should at least try to tell me. Okay. It is related to Schedule 3 format. So now I think you should be able to help me out. Statutory dues disclose separately नहीं है. Other current liabilities should be split into other financial liabilities and other current liabilities. Statutory dues payable, is it a financial liability or a non-financial liability? You guys have studied Ind AS 109 on financial instruments. So tell me now, is it a financial liability or a non-financial liability? Where right now other current liabilities is at 30,000 because 15,000 we have removed the proposed dividend. We have removed proposed dividend. Okay. So 30,000 mein we are having 15,000 included. We are having 15,000 included. Okay. So now my question to you is statutory dues payable in cash. Is it a financial liability or a non-financial liability? It is a non-financial liability. Sir, it is deliverable in cash. Agreed. But is it pursuant to a contractual obligation to deliver cash? Answer is no. You are not entering into a contract with the government. Statutory liability is a statutory imposition upon you without a contractual obligation, and therefore it will not become a financial liability. It will remain a non-financial liability. And that is why 15,000 will remain here and 15,000 will be classified into other financial liabilities. It will be classified into other financial liabilities. Okay. Are we clear with this? Yes. Are we clear? Any doubts about this so far? No doubts. So now this is reclass adjustment. That's it. This is reclass adjustment. 30 will not become 45 beta. ठीक है? 30 है, उसका split up is what is given to us. Okay? The split is what is given to us. Okay? All right, fine. Coming to the next one. The capital advances amounting to 50,000 are grouped under other non-current assets. Bolo. So this is done. Capital advances amounting to 50,000 are grouped under other non-current assets. Is any adjustment required? Yeah, tell me. Mohammed, was the earlier one clear, beta? Yes. Okay, fair enough. So tell me now, what about adjustment 7? It's not CWEB. It cannot be capital work in progress. You have given capital advance. Material has not yet come. It is not a financial asset. That is right, because you are going to get an asset against this. You are not going to get cash. So it is a non-financial asset. Where it is grouped under other non-current assets. Do I have any deferred tax implication? Answer is no, sir. Even under tax base, yahi hoga 50,000 rupees. And here also it is 50,000 rupees. No adjustment required. They have just given it as an information. They have just given it as an information. तो वो है अदर नॉन करंट एसेट्स, रहने दो उसको अदर नॉन करंट एसेट्स में, लेट इट बी अंडर नॉन करंट एसेट्स. देयर इज नो प्रॉब्लम, देयर इज नो प्रॉब्लम. ओके, आर वी क्लियर विद दिस? यस. So 7 is done. Adjustment 8. Other current assets of 51,000 comprise interest receivable from trade receivables. Okay. What do I do with other current assets? What do I do with other current assets? 51,000. 51,000. Heading also will remain the same, huh? Yes. It is a financial asset. Absolutely right. It is a financial asset. So adjustment 8, this has to go under other financial asset. Absolutely right. Sumit, Satish, absolutely right. Other financial assets. Okay. Reclass. No deferred tax implication, nothing. Okay. Current investment of 30,000 is in shares of a company which was done with the purpose of trading. Current investment has been carried at cost in the financial statements. Fair value of current investment in this case is 50,000 at 31st March 20x2. Okay. Tell me. Tell me. It is held for trading. So do I do FVTPL or FVOCI? Namrata, Mansha, Tanisha, Shravani, Shruti. It is a financial asset. Yes. But what is it? Do I do it as an FVTPL, FVOCI? Do I carry it at cost? What does 109 tell us? Yes. FVTPL. See, the intention is held for trading. Equity anyways has to be fair value. There is no doubt about it. And this is so for trading. So therefore FVTPL. Acha, FVTPL means, let us come here, adjustment 9. Adjustment 9. Okay. Carrying amount 30,000 right now. This will be increased to the fair value of 50,000. Tax base will remain at 30,000. There you will not increase. You will not increase. Yes, you will not increase. And therefore, you are going to treat it as having a tax base of 30,000. So carrying amount is greater than the tax base gives rise to a deferred tax liability. इसका DTL भी होगा, इसका DTL भी होगा. Okay, you want me to repeat adjustment 8? I will come back after I finish adjustment 9. Okay, I'll come back to that. Don't worry. Okay, all right. So therefore, DTL is equal to 20,000 into 30%. So that is equal to 6,000. So what is the journal entry, boss? The journal entry will be investment in equity shares debit 20,000 to deferred tax liability 6,000 to P&L 14,000. Sir, ऐसे कैसे? I just clubbed two entries. You would do investment in equity shares 20 to P&L 20, and you would do P&L account debit to DTL 20,000. Okay, so I just combined. I'll write the second, both the entries here. Investment in equity shares 20,000 to P&L 20,000. P&L to DTL 6,000. Okay, 6,000. Okay. All right. So now coming to this one, कहाँ change होगा? First one, this is adjustment 9. So 30 will become 50,000. 30 will become 50,000. Coming next, other income, we will add 20,000. Adjustment 9. This is fair value gain that is happening. And finally, my deferred tax, adjustment 9. This is going to go up by 6,000. Yes. And here again, deferred tax, adjustment 9, 6,000 plus 6,000 minus 7,200. Fair enough. Are we able to follow? Yes. Are we able to understand this? Any doubts, difficulties? Yes. Any issue with this adjustment, boys and girls? Any issue with this adjustment? Yes. Namrata? Shruti, Samjha? Satish, did you follow? Mohammed, did you follow? Sumit, Prashant, Satish, Mansha, Tanisha, Viraj. Are we together? Understanding? Yes. Perfect. All right. Okay. Namrata, adjustment 8. See, other current assets of 51,000. This is nothing but interest receivable. This is nothing but interest receivable from trade receivables. Means probably your debtors had not paid you on time. So you had charged interest. That is 51,000, which you will get it in cash. And that is why, though it is shown as other current assets, it will ultimately be a financial asset because it represents a contractual right to receive cash. And therefore it will be classified as a financial asset under current assets. That is it. Nothing else in adjustment 8. Okay. So adjustment 8 is done, 9 is done. Coming to adjustment 10. Actuarial gain on employee benefit measurements of 1,000 has been omitted in the financials of Soft Bharati Private Limited for the year ending 31st March 20X2. Perfect. So now एडजस्टमेंट 10 जो जो हमने पढ़ाया है वही है, मोस्ट ऑफ इट एक्सेप्ट फॉर फाइनेंशियल इंस्ट्रूमेंट्स. ओके. ऑल राइट. Actuarial gain is happening, right? Actuarial gain or loss? Actuarial gain on employee benefit measurements. Okay. Tell me, actuarial gain. Where will I show this? Once upon a time, we had studied Ind AS 19. Once upon a time. Yeah. Go back to once upon a time and tell me. Defined benefit plan. That's right. And the treatment you have given also is right. Perfect. Anybody else? That's right. Prashant is right. Guys are brilliant. Okay. What about the others? Absolutely right. Great. Teen answer, Tino bull's eye. All the three answers have hit the bull's eye. Okay. Yes. So this is an actuarial gain or loss that has happened. Actuarial gain in this case. So actuarial gain is due. Why it will go to other comprehensive income? Let us understand that, number one. Then we shall understand why it will be non-reclassifiable, and then we'll take the entry and close it. Okay. Adjustment 9, it will go under non-reclassifiable OCI. Why OCI? Because it is an actuarial gain. Actuarial gains means there has been an actuarial remeasurement which has happened. There has been an actuarial remeasurement which has happened. This actuarial remeasurement is due to factors, due to change in actuarial assumptions. Okay. You can change your actuarial assumptions to adjust your profit. So that is why the standards have said that actuarial movements will always be routed through OCI, never through the profit and loss. So इसके लिए वो गए under other comprehensive income. And now, why do I take it as non-reclassifiable? Because at any point of time, I do not want change in actuarial assumptions to ever hit my profit and loss account. And therefore, from actuarial, from other comprehensive income, it will directly move to the reserves as a remeasurement reserve. It will not be routed through the profit and loss account. So brilliant. So therefore, to other comprehensive income, non-reclassifiable 1000. Debit क्या होगा? Sir, debit के लिए there is only one item that makes sense, and that is long-term provisions. Okay, that is long-term provisions. Because nowhere else I have seen any other head that makes sense. So long-term provisions 1000. Okay. So now, will this have a deferred tax implication? Will this have a deferred tax implication? Will this have a deferred tax implication? Yes, obviously. So now carrying amount is 24,000. Tax base is 25,000. You will get a deduction when it is actually paid. So this is carrying amount is less than the tax base of a liability. So it gives rise to a DTL. So therefore, DTL is equal to 1000 into 30%. So that is 300. That is 300. Okay. So the tax base, you will get the deduction when it's actually paid. But here, for accounts purposes, you will have to do accrual accounting and then actuarial gains, losses, etc. So carrying amount keeps fluctuating. So that is why you are going to have a deferred tax implication. So this gives rise to a deferred tax liability. Where will this go? Where will this go? This will not hit the profit and loss account. This will be in the other comprehensive income. Sir, why? Because the item is in other comprehensive income. The item relating to the remeasurement or actuarial gain goes under other comprehensive income, and that is why this also deferred tax impact goes in the other comprehensive income. Other comprehensive income debit to deferred tax liability 300. 300. So let us come to our question. Other comprehensive income, actuarial gain 1000 less deferred tax. Deferred tax 300. So this falls to 700. We have debited long-term provision, Namrata. There is no other place to debit. See, look at the items. Current assets मध्ये किती आहे? You are having current as investment, you are having inventories, you are having trade receivables, cash and other current assets. None of this makes sense for me to regard it as being a part of employee benefits. Coming to non-current assets, you are having other non-current assets. They have told you what is there. They have told long-term loans and advances. You will definitely not show your defined benefit plan investment under long-term loans and advances, property, plant and equipment. Coming to current liabilities, trade payables not related to employees, other current liabilities, they have told you that it includes your statutory dues and others. And short-term provisions, they have already said that it pertains to income tax. Coming to non-current liabilities, deferred tax, Obviously, share capital reserves will not be there. So there is only one item which makes sense, that is long-term provisions for the purposes of employee benefits. So that is why we have to debit long-term provision. If any other item was there which was specifically identified for this, we would be debiting that item. Are we clear with this? Yes. So that is the reason. All right. So that takes care. All right. Coming here, your deferred tax increases by 300 and this is adjustment 10. And 25,000 will reduce by 1,000. 25,000 will reduce by 1,000. Sir, it means whenever fair value changes or charge to P&L, FVTPL or FVOCI, deferred tax will definitely come, obviously. Because see, what happens is income tax never recognizes fair value movements. Okay. On a conceptual level, income tax bolta hai, sir, I'm not bothered with what you do in your books. Basically, what I am looking at is if it is equity share and you are selling it, I will tax you at the time when you sell it. I will not tax you on unrealized gains or losses. In fact, taxpayer would be the first one to shout if they say that on fair value the company has to pay income tax. They will obviously say that I have not even got the money. Who are you to come and tax me right now? That is why income tax department will say, I will not charge you on fair value movements, but I will charge you when the asset is actually sold at the original cost of acquisition. And therefore, any fair value movement will always have a deferred tax implication. Similarly, other comprehensive income items also, it will have a deferred tax implication. Okay. The key is, when do I apply it? If you are given tax rate in the question and they have given you a hint that deferred tax is there, you have to apply it for each and every adjustment. You have to apply it for each and every adjustment. Okay. So I think with this, we have kind of completed the question. Yes, the financial statements have not yet been approved. Ascertain whether the financial statements are correctly presented. No, they are not as per the applicable reporting framework. If not, prepare the revised financial statements of Soft Bharati Private Limited after a careful analysis of mentioned facts and information. Okay, so we have completed everything. So now all that you need to do is you need to do the addition, subtractions, and then you need to present the financial statements in line with schedule 3 division 2. Is it okay? Can you do this for me, please? Can you do this for me? Yes. ये कर सकते हो. अभी खाली बैलेंस शीट बनाने का है आपको. ठीक है. Now you only have to do a balance sheet for me. 227,500 plus 15,000 plus 700. Adjustment 10. Are we clear? Yes. समझ में आ गया अपने को? Anybody has any doubts? No doubts? ठीक है. Yes. All right. So we take a 10-minute break. It is 8:10. Okay. It is 8:10. So we reconvene at 8:20. We'll do another one or two case studies, not so big, but we'll do another couple of case studies before calling it a day. Okay. A 10-minute break, please. Yes. Yeah. Okay. Welcome back. Yeah. So this was a good case study from that perspective. It did give a lot of revision of what we have already gone through. Okay. So that takes care of case study 5. All right. Coming next, you can go through this by yourselves. Okay. Uh, See the entire presentation. I doubt whether you will get such a big question in your examination because this is really a big question. Okay, it's quite big. It's bigger than even the consolidation questions that you are expected to get. So from that perspective, yeah, but let us see how it pans out. Okay, coming next, we'll do a couple of case studies and then let me see how to go about it. Okay, all right. Mumbai Challengers Limited, a listed entity, is a sports organization owning several cricket and hockey teams. The issues below pertain to the reporting period ended 31st March 20x2. Owing to the proposed schedules of Indian Hockey League as well as the Cricket Premier Tournament, Mumbai Challengers Limited needs a new stadium to host the sporting events. This stadium will form a part of the property, plant and equipment of the company. Fair enough. Mumbai Challengers began the construction of the stadium on 1st December 20x1. The construction of the stadium was completed in X2, X3, that means the next year. Costs directly related to the construction amounted to 140 crores in December 20x1. Thereafter, 350 crores have been incurred per month until the end of the financial year. The company has not taken any specific borrowings to finance the construction of the stadium, although it has incurred finance costs on its regular overdraft during the period, which were avoidable had the stadium not been constructed. Which were avoidable had the stadium not been constructed. Okay. Mumbai Challengers has calculated that the weighted average cost of the borrowings for the period 1st December X1 to 31st March X2 amounted to 15% per annum on an annualized basis. The company seeks your advice on the treatment of borrowing cost in its financial statements for the year ending 31st March 20x2. Okay, quickly tell me, is this a qualifying asset? Number one. Second, should I capitalize the borrowing cost? Number two. Third, how much should I capitalize? Number three. So, three questions. Qualifying asset, do I capitalize? How much to capitalize? Okay. Relevant standard, Ind AS 23. So please just kind of try to recollect that and give me the answer. Come on, where is everybody? Is it a qualifying asset? Is it a qualifying asset? Yes, sir. It is taking substantial time to get ready for its intended use. So it is a qualifying asset. Okay. So now coming to case study 6. It is a qualifying asset. It is taking substantial time to get ready for its intended use, number one. Second, do I capitalize the borrowing cost? Answer is yes. But sir, they have not taken specific borrowings. Doesn't matter. Even general borrowings, if they are there, if you can calculate the weighted average borrowing rate, then taking that rate, you can do the calculation for the borrowing cost to be capitalized. So we will capitalize the borrowing cost. So December, sorry, 20x1, you had spent 140 crores. Rate of interest is 15% till end of the year, means 4 months by 12 months. So this comes to 7. Thereafter, every month you are taking 350 crores. So Jan 20x1, 350 crores into 15% into 3 by 12. 350 crore. P50, 13.125. Then Feb 20x1, absolutely right. So 350 into 15% into 2 by 12, 8.75. And March, sorry, this is 20x2. March 20x2, 350, 15%, 1 by 12. 4.375. So that gives you 33.25. So this is the borrowing cost that will be capitalized, assuming of course that your borrowing cost is greater than this. Okay. So the CWIP, the capital work in progress, would be 140 plus 350, 350, 350 plus 33.25. So this will be the value of the construction work in progress plus 33.25. 1,223.25 crores. This will be the value of the asset. This will be the value of the asset. Are we clear with this? Yes. Shruti, Namrata, Mansha, Shravani, Viraj, Mohammed, Prashant, Satish, all clear? Any doubts? Anyone? Okay, so that's it. So that takes care of part 1. Okay, coming to part 2. D. Mumbai Challengers acquires and sells players' registrations on a regular basis. For a player to play for its team, Mumbai Challengers Limited must purchase registrations for that player. These player registrations are contractual obligations between the player and the company. The cost of acquiring the player registrations include transfer fees, league levy fees, and player agents fees incurred by the club. Okay. Take the case of any IPL team, right? So you have a team like Mumbai Indians or Royal Challengers Bangalore or whatever it is. So you had these players who are purchased by these teams, like Dhoni is with Chennai Super Kings, or Kohli is with Royal Challengers Bangalore, or Rohit Sharma is with Mumbai Indians, right? So now, when these teams purchase the registrations of these players, when they purchase the registrations of these players on a regular basis, is it a cost that hits the P&L, number one, or is it an asset that needs to be recognized in the books? Is it an asset that needs to be recognized in the books? What do you think? Virat Kohli in the books of Royal Challengers Bangalore, what will it appear like? What will his contract appear like? Will it appear, I paid Kohli say 5 crore rupees. Okay, I don't know how much is the auction value, but suppose I pay him 5 crores. Will it hit the P&L or should I capitalize it? If I capitalize it, where should I capitalize it? And what is the data? What is the expectation? Yes, it is an asset. It is an asset. Okay. I don't own Virat Kohli, but I have a contract that mandates him to play for Royal Challengers Bangalore. Same goes with CSK for Dhoni and Mumbai Indians for Rohit Sharma. Okay. So now these teams own the contractual obligations in respect of these players. So therefore, these players are nothing but intangible assets. They are nothing but intangible assets. Okay. Now, if they are intangible assets, that means which standard will apply? Ind AS 38 will apply. Okay. The cost of acquiring the player include transfer fees, this, that, everything, 3, 4 items they have given. That means what is the purpose of this? This is the intent. They want to state that cost can be measured reliably. Cost can be measured reliably. And cost can be measured reliably means that we are going to capitalize it. There is no reason not to capitalize because the main problem with intangible asset is measuring the cost. But these are acquired intangibles. And when I'm acquiring intangibles, I know what I'm paying for. And therefore, since the costs are known to us, we can capitalize it. The cost can be measured reliably, number one. Second, if it is an asset, at any point of time, you will have people moving from one franchisee to the other. Like you had Gujarat Titans, Hardik Pandya moved from Gujarat Titans to Mumbai or Mumbai to Gujarat. Kuch to chal raha tha 6 months back or 3, 4 months back. Something was going on. I don't know from where to where that guy has moved, but he has moved from one team to the other. Now, when Hardik has moved from one team to the other, for the existing team where he's there, and I am moving it from, say, team X to team Y, I'm in the books of team X, that person, his contract is now going to become a non-current asset held for sale. वो जा रहा है. I have put him up for an auction again. And because I have put him up for an auction, that person is going to be, that person's contract is going to be shown as now a non-current asset held for sale. Okay, is now going to be a non-current asset held for sale. And therefore, you will show at cost or fair value less cost to sell, whichever is less. Second. Third part. Some of these players may have small niggles, injuries, छोटे छोटे injuries होंगे, एक दो मैच के लिए खेलेंगे नहीं, then they will again play. On the other hand, you have somebody like Rishabh Pant who had a life-threatening accident that happened, which put him out of action for 1 year or 1.5 years probably. Okay. Now Rishabh Pant plays for Delhi, I suppose, right? So if Rishabh Pant had a contract with Delhi and he's unable to play, that means there could also end up being an impairment. There could also end up being an impairment of assets. So you are having recognition of intangible assets because the cost can be reliably measured. Example, Kohli for Royal Challengers, Dhoni for Chennai Super Kings, Rohit Sharma for Mumbai Indians. You are also having a case where players are put up for auction, So when players are put up for auction, that means existing teams want to give up these players. So for these existing teams, it will end up becoming a non-current asset held for sale, where you have to show it at fair value less cost to sell or cost whichever is lower. And third one is we are going to have a case where a player is severely injured, unable to contribute in the season. So this becomes an impaired asset, like Rishabh Pant, who has met with a fatal accident, who is now coming back slowly to the team. So all these three cases are there. If the players are not retained, then will they always be current assets? It depends. See, when you say not retained, what do you mean by not retained? It is a floating population. Every year they go for an auction. If every year they go for an auction and you pick them up every year, then there is no need to book them as an asset because you are getting the benefit only for 1 year. And therefore, it would be better to treat their costs as a charge against the profits that the franchisee is earning if the player is not retained. Like you will be having some floating population always. Like for example, you have I don't know who is the floating population where, but you have suppose hypothetically you have let us assume you have what is that guy's name? You have Ravindra Jadeja, for example. Okay, this season he's playing for Chennai. Next season he's playing for Mumbai. Then the next season he's playing for Lucknow, Pune. Like that he goes on playing. He is never anchored to one place. He is every year put up for auction. He is not anchored to a particular team. At that point of time, that person will never be recognized as an asset because though he is an economic resource, it is for a limited time period. It is not even exceeding 1 year. Before the next season, he's already put up for auction. And therefore, at that point of time, his costs will ideally be charged to the profit and loss account and it will not be hitting the asset because the contractual obligation is only for 1 season. Next season, you are again going to go for a fresh auction and a fresh team. Okay, so there is no contractual obligation to continue. Okay, so you have all these kinds of permutations and combinations which are there in the what you can say in the IPL or so this was actually taken from there. Okay, so basically this question you have these clubs in the European Premier League like Manchester and Arsenal and I don't know what all are there. Okay, so Manchester, Arsenal, they follow similar models, and in fact, IPL is the brainchild, and it is drawn inspiration from the English Premier League. So the Indian Premier League is an offspring of that. That was football. This is cricket. Yeah. So therefore, this question has come. The source is there. Okay. We just modified it. Okay, and we changed the name so that it may not end up into like I did not take Royal Challengers, we have taken Mumbai Challengers, so it does not create any confusion or any issue should not happen. Okay, all right. Coming next, Mumbai Challengers acquires and sells players' registrations on a regular basis. Okay, so this part we have read. At the end of each season, which also happens to be the reporting period end for Mumbai Challengers, the club reviews its contracts with the players and makes decisions as to whether they wish to sell or transfer any players' registrations. The company actively markets these registrations by circulating with other clubs a list of players' registrations and their estimated selling price. Actively markets means Ind AS 105. Players' registrations are also sold during the season, often with performance conditions attached. In some cases, it becomes clear that a player will not play for the club again because, for example, a person sustaining a career-threatening injury or being permanently removed from the playing squad for any other reason. So there could be an offense involving moral turpitude. Okay, so like there was a fixing scandal that happened where some players were threatened, were forced to leave, not to play for the country, not to play for any league. So therefore, that could also be a case of what you can say impairment. And of course, a life-threatening injury to Rishabh Pant, which made him remain without action for the 1.5 to 2 years tenure. Impairment. It amounts to impairment. Though Delhi Capitals has still held him, but it is an impaired asset for 1 season or 1.5 year, whatever the case may be. Okay. The players' registrations, the playing registration of certain players were sold after the year end for total proceeds net of associated cost of rupees 175 crores. These registrations had a net book value of 49 crores. Ind AS 105, this is nothing but fair value less cost to sell 175, and this is the book value 49. Show at lower of the two, so it will be seen at 49 crores. Mumbai Challengers seeks your advice on the treatment of acquisition extension. So for acquisition and extension, we are going to have intangible assets that will apply. And for the purpose of review and sale, it will be Ind AS 105 that applies. Or if it is an impaired asset, Ind AS 36 will apply. So you just have to explain your answer in words in the circumstances outlined above. All right. Coming next, Mumbai Challengers measures its stadiums in accordance with the revaluation model. Is it permitted to do so? Yes, it is permitted to do so. An airline company has approached the directors offering 700 crores for the property naming rights of all the stadiums for 5 years. Okay. So typically you have these, if you have, I don't know, but you have these companies, you have this metro that is there in Mumbai. I'm not sure how many of you are from Mumbai, but in Mumbai, you have the metro that runs from Warsaw to Ghatkopar, or you also have a metro that is running from Dahisar to Andheri or somewhere like that, I suppose. And we are now having another metro that is coming from Kaf Parade to Dahisar, right? So now these stations, many times they are named with companies. Okay, they are named with companies like ICICI Bank, Andheri, or Axis Bank, Chakala. Like this, they give the names. Even in Bangalore, you may be having some metro stations where the names of the companies are given. Okay, so now the thing is, when names are given, वो free में नहीं होता है. If you give a name like ICICI Bank Andheri station, that means ICICI Bank has paid Mumbai Metro Development Corporation an amount to add its name to the name of the metro station. Okay, so announcements may be ICICI Bank Andheri. Board also will have ICICI Bank Andheri. Okay, so it is kind of a surrogate advertising that is happening. But now the important point is, when you are naming, you have to give an amount. You have to give an amount. In this case, airline companies want to name the stadium after the airline. So probably you would have a thing like Indigo Wankhede Stadium, Mumbai. Or you could be having something like Vistara Brabourne Stadium, Mumbai. Okay. Or Vistara with Nagpur Stadium, Maharashtra. You could be having these kind of names. So for this, the airline companies like Indigo or Vistara will pay the stadium something, and the payment to the stadium will be done, and then the stadium is going to be named. The stadium is going to be named after that airline. So it gives kind of an advertising and a sponsorship also to the stadium. Now, for the airline company, it is very simple because it knows that it has to pay X amount. In this case, it has to pay 700 crores for the property naming rights. So if I look at, suppose Vistara wants to name Wankhede Stadium. So Vistara Wankhede Stadium, Mumbai. So if it wants to name, it has to pay 700 crores to Mumbai Cricket Association. It has to pay 700 crores, and then वो नाम चिपक जाएगा for a period of 5 years. But the problem is now Mumbai Cricket Association, or in this case Mumbai Challengers, is doing the accounting on a revaluation model. And revaluation model means you have to follow the fair value. And you have to follow the fair value means fair value will comprise of not only the cost but also the cost of these assets. And now the problem is Mumbai Challengers Limited will not know what is the fair value of the right that it is going to get. So therefore, it has to adopt a fair valuation approach. It has to adopt a fair value hierarchy. Sir, do I have an observable input? Sir, you will not have an observable input for naming rights because that is something which is internally generated. So therefore, how am I going to adopt? Will I have an idea of the cost I have incurred? Yes, you have an idea for that. Do I have an idea of the value of the stadium surrounding me? Definitely, you will be having stadiums dotted across Mumbai's coastline and even in Maharashtra, Pune nearby. So you will have an idea of what will be the value of the stadiums. So probably you may not be able to exercise level 1 input, but you can go for level 2 input where you can do observable inputs plus minus certain adjustments for location, space, etc. Or the third case, you can go ahead for unobservable inputs, in which case you have to do a present value of the cash flows generated from the stadium operations. like how many matches will be played, what is the expected revenue. So then you streamline, you arrive at a terminal value, discount it to present value. The naming rights will be how much. All of this is going to give you a cash flow model, a discounted cash flow model, which you will discount to present value, and that will become the fair value of that stadium. And the fair value of that stadium will then be used for the purpose of applying the revaluation model. For the purpose of applying the revaluation model. Three directors are on the management boards of both Mumbai Challengers Limited and the airline. So airline and the Mumbai Challengers company has same directors, need not be related under Ind AS 24 because common directors does not necessarily mean that the companies are related to each other. Additionally, statutory registrations regulate the financing of both the cricket and hockey clubs. These regulations prevent contributions to the capital from a related party, which increases equity without repayment in return. That means airline company giving naming rights is probably not permitted if the airline company is related to Mumbai Challengers Limited until a repayment mechanism is in place, until a repayment plan is in place. But is the airline company and Mumbai Challengers Limited, from India's perspective, they are not. But from the perspective of other laws and regulations like Companies Act, or for example, the income tax and or whatever legislations are there, related party definitions could be different, and therefore under those, are they related parties or not is something you will have to check. Okay. Failure to adhere to these legislations could lead to imposition of fines and withholding of prize money. They want to know how to take into account how to take account of the naming rights in the valuations and the potential implication of the financial regulations imposed by the legislators. Okay, so therefore they are not related party as per Ind AS merely because of common directors, but you have to check at the respective laws for the definition of related parties. And yes, if you are meeting the criteria to accept the money, then you will have to apply a fair valuation model under Ind AS 113 and take it into your revaluation model and accordingly apply Ind AS 113 to determine the fair value of the stadium, which you can use for your accounting. Okay, so that takes care of this question. Okay, that takes care of this question. A very nice case study where you see a lot of applications of your Ind AS. Okay. All right. Coming next. So you can read the solution yourselves. I don't foresee any challenge. It's particularly simple, not very difficult. Okay. All right. Now. Okay. All right. We do another case study. Anybody has any doubts in this question? Anybody has any doubts in this question so far? Point C. Point C, please summarize. Well, you can include it in the fair value if you are not violating the provisions of related parties. For including it in the fair value, you have to adopt a fair valuation model, and the fair valuation model will include the cost of the stadium, the surrounding prices, level 2 or level 3 inputs, and for the purposes of naming rights, you will have to estimate based on level 3 inputs and arrive at the fair value. That's it. That's about it. Okay. Basis which you can arrive at the fair value and then apply the revaluation model accordingly. Okay. Let us then proceed further. Case study 7. Shall we proceed further? Anybody has any doubts? Shall we proceed? Muhammad, is it clear? Sumit, is it clear? Prashant, Viraj, Shruti. Shruti is not there. Huh? Is it clear? I've taken away your Sunday evening. Okay, fine. Last question for the day, then we shall wind up. Then the next class, I'll pick up some mixed questions of India's 101, where you have analysis part also that is there. And we will also do some more questions on analysis and close it. Okay. So last question. Case study 7, Neelanchal Gas Refinery Limited, hereinafter referred to as Neelanchal, a listed company, is involved in the production and trading of natural gas and oil. Neelanchal jointly owns an underground storage facility with another entity, Seemanchal Refineries Limited, hereinafter referred to as Neelanchal. So I have two companies, Neelanchal and Seemanchal. Both of them are jointly owning an underground storage facility. Underground storage facility. They are jointly owning the facility. They are different entities, mind you. They are different entities. So they are jointly jointly owning the facility. Okay. Both the companies are engaged in extraction of gas from offshore gas fields, which they own and operate independently of each other. So Neelanchal has its own operations. Seemanchal has its own operations. So Neelanchal and Seemanchal are two independent entities. They are not even related. But for the purpose of storing the gas that they have extracted, they need a storage space. And storage space typically will be in pipes that run into kilometers of length. And therefore, that is done as a joint ownership, on a joint ownership basis, where they own the asset. Which asset? The storage facility together. Okay. Neelanchal owns 60% of the underground facility. Seemanchal owns the remaining 40%. Both the companies have agreed to share services and costs accordingly. Absolutely. With decisions related to the storage facility requiring unanimous agreement of the parties. You tell me now, you have studied joint control, joint ownership, joint arrangements, joint ventures. Sab padha hai aapne, you know everything. Do not look at the solution. This particular arrangement, this jointly controlling the underground operations, jointly controlling the underground storage facility. You tell me, is it a joint venture or is it a joint control? Does joint control exist? Number one. Is it a joint venture? Is it a joint operation? Is it a joint arrangement? What is it exactly? What is it exactly? Okay. First of all, is there joint control on the underground storage facility? Is there joint control on the underground storage facility? There is joint control. What is the fact that there is a joint control? Well, the fact that there is a unanimous agreement of the parties for operating storage facility indicates that joint control exists. Now, is it a joint venture? For a joint venture, a separate legal entity is required. Here, there is no separate legal entity, and therefore, joint venture is not there. What is there is a joint arrangement because of a joint control, and this joint arrangement is in the nature of joint operations, Why joint operations? Because both of them do not form a separate legal entity, but they are controlling the facility together. So therefore it is a joint operation. And because it is a joint operation, Ind AS 111, what consolidation method will you follow? Will you follow equity method prescribed under Ind AS 28 for joint ventures and associates? Or will you be following proportionate consolidation, which is prescribed under Ind AS 111? क्या करोगे? जल्दी बताओ. What are you going to do? Will you follow equity method of accounting or will you follow proportionate consolidation as mentioned in Ind AS 111? Proportionate consolidation. Absolutely right. So Neelanchal will account for 60% of cost, 60% of asset value, 60% of any provision for restoration, etc., if it is there. And दूसरा कौन सा है सीमांचल सीमांचल will account for 40% cost 40% of asset 40% maintenance 40% provision etc. So proportionately they will consolidate the amounts in their financial statements. Is it okay? Yes. So most of all of you have given the same answer. So moving forward, let us proceed. The underground facility is pressurized so that the gas is pushed out when extracted. So they put a particular pressure. So when you put the pressure, the gas comes out of the outlets and then it is accumulated. When the gas pressure is reduced to a certain level, the remaining gas is irrecoverable and remains in the underground storage facility until it is decommissioned. So entire gas cannot come out of it. There will be some amount of gas. See, because what happens is the storage facilities are confined spaces. Okay. Now, when you want to push the gas outside, you need to put so much of gas pressure in that the gas ultimately finds a way out of the outlet. Suppose your pressure is not adequate, space is large, gas content is low, then that gas is always going to be irrecoverable. That gas will always remain irrecoverable. उसको आप decommissioning के time पे ही निकाल सकते हो. You can remove that gas at the time of decommissioning only. Only when you pull out that pipe and you decommission and restore the entire facility, that time whatever pipes you have extracted, from there you can extract the gas. Otherwise, as long as the pipes are underground, you cannot make the gas in that facility zero. That is never possible because some amount of gas will remain because gas will be low and space will be more. So pressure cannot be created. As per the laws in force, the storage facility should be decommissioned at the end of its useful life. Neelanchal seeks your advice on the treatment of the agreement with Seemanchal. Treatment of agreement with Seemanchal is going to be a joint operation with proportionate consolidation as well as the accounting for the irrecoverable gas. Okay. The underground facility is pressurized. How do they pressurize this? They will put some gas from outside to create pressure in the underground storage facility. Now that gas which is there, that gas will have some amount of cost. You know the cost of putting that gas inside, and that gas in turn is going to generate a pressure that will push out the existing gas outside for your operations. So that irrecoverable gas which you are now putting from outside inside, that gas will remain irrecoverable. This was the tactic that you did so that existing gas can be pushed outside entirely. So that is an external force which you have created. Now that external force is a resource. That resource is giving rise to an economic benefit. Sir, kaise? It is pushing out the existing gas from the storage facility to the entity so that you can use that for the purpose of your operations. And therefore, it is an external source. You are able to measure it. You are able to measure the cost reliably. That is put inside. It is a resource. You are controlling it. You are able to generate economic benefits by pushing the underground gas outside so that you can carry out your operations of running the gas operations. And therefore, that irrecoverable gas which you are putting in, surprising though it may seem, it meets the definition of Ind AS 16. Because that irrecoverable, it meets the definition of property, plant and equipment under Ind AS 16. PPE कैसे हो गया सर? गैस PPE थोड़ी होता है. gas becomes a property, plant, equipment, because now you can reliably measure the cost. It is going to give an economic benefit to you in the sense that it pushes out the existing cost, right? And therefore it becomes an asset for you. So the irrecoverable gas which you are putting from outside will remain an asset, and that will be recovered at the time of decommissioning. That will be recovered at the time of decommissioning. Is it okay? So that is case study 7, part A. Anybody has any doubts here? So treatment of agreement with Seemanchal, joint operation, proportionate consolidation. And irrecoverable gas, property, plant, and equipment. Property, plant, and equipment. Capitalize and depreciate. Capitalize and depreciate. The gas is basically bringing your facility in a ready-to-use condition. That is why it becomes a property, plant, and equipment. Coming next, question B. Neelanchal has entered into a 10-year contract with Uttaranchal Refineries Private Limited for purchase of natural gas. Okay. Neelanchal has paid advance to Uttaranchal equivalent to the total quantity of gas contracted for 10 years based on the forecasted price of gas. That means it has entered into a forward contract. It has entered into a forward contract. And okay, not a forward contract, it has paid an advance. It has paid an advance. Okay. This advance, you will get natural gas in return. You will get natural gas in return. This advanced amount carries interest at the rate of 12.5% per annum. So there will be a 12.5% interest, but this interest is settled by Uttaranchal by way of supply of extra gas. 12.5% interest settled in sale of natural gas, settled by sale of natural gas. So again, principal is also not coming back because you are getting natural gas for it. And interest also not coming back because you are getting natural gas for it. So though this is an advance for 10 years, it is not a financial asset because you are not having a contractual obligation to receive cash. You are having a contractual obligation to receive, you are having a contractual right to receive natural gas, not a contractual right to receive cash. And therefore, it is not a financial asset. This advanced amount carries interest. Okay, that is done. The contract requires fixed quantities of gas to be supplied each month. Okay. Additionally, there is a price adjustment mechanism in the contract whereby the difference between the forecasted price of gas and the prevailing market price is settled in cash on a quarterly basis. This could be a financial instrument because the price differences are being adjusted in cash. But this is a derivative contract, and this is a derivative contract for own use, for which you are doing a gross settlement, and therefore financial instruments on the entire transaction per se, that is advance plus interest thereon, will not be applicable. If Uttaranchal does not deliver the gas as agreed, Neelanchal has the right to claim compensation computed at the current market price of the gas. Computed at the current market price of the gas. Neelanchal wants to account for the contract with Uttaranchal in accordance with Ind AS 109 financial instruments and seeks your inputs in this regard. Okay. First one, advance plus interest, not financial instrument. Why? Because there is no contractual right to receive cash. You are getting natural gas in its place. Okay. Now, this is kind of a commodity derivative. This is one way of interpreting. Second way of interpreting is this is a commodity derivative where you are settling it by way of actual settlement for own use. So, commodity derivative own use exemptions Ind AS 109 will not be applicable. Commodity derivatives net settlement in cash, Ind AS 109 applies because it is a financial instrument where you have a contractual obligation or right to deliver or receive cash based on the price fluctuations that happen. Okay, so therefore it is not a financial instrument, not a financial instrument, and thereafter you cannot account for it as a financial instrument. You cannot account for it as a financial instrument. Are we clear with this? Yes, anybody has any doubts? No doubts? Okay. These are executory contracts because Uttaranchal is yet to supply. Uttaranchal is yet to supply. So these are executory contracts. These are executory contracts. Termination penalty or price adjustment. This is what is happening in cash. Only this could be financial instruments. Okay, are we clear with this? Are we clear? Yeah. So please go through this solution once. I have summarized the entire problem for you. So please go through the solution once. I believe that a lot of things, whatever we have discussed, you can be clear about that. Okay. I want you to try question number 1 for homework. Question number 2 for homework. These are all small questions. Okay. Question 3, question 4, question 5, I will be doing it in the next class. Okay, I'll do question 5 in the next class. Question 6 also I'll try to do. It is an Ind AS 101 question. Okay, so question 5 and question 6 I'll try to do in the next session. And apart from that, anything else, if it is there, we can have a look. I presume that will be your last class. So you are left with March and April for your remaining subjects and preparation. Okay. All right. Thanks everyone for a patient hearing. And we shall meet again on, I think 28th is the next session, right? So 28th we shall meet and close the session. All right. So that's it for today. Thank you everyone and see you on 28th. Okay. Yeah. Thank you. The session done. Session done. Thank you. Good night.